All right. Good afternoon, everyone, and thank you all for joining us for today's A Month of Service presentation. This is our Money, Health, and Wealth Financial Capability Series. Today's topic, we're talking about credit and debt management and how managing debt impacts your credit score. My name is Nia Murray. I am the Programs Coordinator with Neighborhood Recovery Community Development Corporation, and we are one of the partners in the A Month of Service collaboration. Also included is the City of Houston's Department of Neighborhoods, Lone Star Legal Aid, the Earl Carl Institute, Texas Legal Services Center, the Harris Central Appraisal District, Harris County Tax Assessor Collector's Office, the Houston Volunteer Lawyers, and the Harris County Attorney's Office. And together we all make up a month of service. I'm trying to silence my phone here before it starts to go out. Together we all make up a month of service. And basically the month of service is a collaboration of all of our organizations. We come together on a monthly basis, offering a variety of different workshops and pooling a lot of our resources and our initiatives together to create a larger impact, to get as much information out to the community as we possibly can. And it's part of that collaboration is the Neighborhood Recovery's Money, Health, and Wealth Capability Series, and where we talk about credit and debt management and other financial related matters, your relationship with money, how your finances impact your mental health, living benefits and preparing for unexpected life events, and savings plans and spending during the holidays. Everything financially related is part of our capability series. But again, today's topic is credit and debt management. And there's a lot of information that's going to be gone over about how debt impacts that credit score. So all of our Money, Health, and Wealth series are in partnership with the with Family Houston, and Miss Monet Channing is the senior financial coach with Family Houston, who's going to be presenting the information for you today. This is your opportunity to ask whatever questions that you have for this financial coaching expert who's going to be providing the information for you. Again, just do know that we are on a public platform. We do record the session. We also do broadcast live on our social media channels. So we do ask that you don't divulge any personal detail information about yourself or where you live or anything like that, because we want to try to protect your privacy as best as we possibly can. However, you do have the opportunity to, put your question in the chat, unmute yourself and participate freely that way. Or, if you are joining us on social media channels, feel free to type your questions into the comment section, and I'll make sure that your question gets addressed aloud at the end of the presentation as well. But throughout the presentation, there'll be an opportunity for you all to kind of interject and kind of provide your input on things from time to time as well. But please feel free to ask whatever questions that is that you may have related to this topic. Let's see, what else is there? Yeah, that's about it. We're going to go ahead and get started with our presentation. And I'd like to go ahead and introduce Ms. Monet Chaney with Family Houston. Towards the end, I will go over a little bit more information about other upcoming opportunities to attend and participate in other workshops and different events and things that we've got that are coming up, but more about that later. So without further ado, we're going to go ahead and introduce Ms. Monet Chaney with Family Houston.
Hi, everyone. My name is Monet Chaney with Family Houston. I'm a senior financial stability coach. And so I collaborate with NIA and NRCDC to go over like the financial topics for our for the money and wellness program. So today we're going to be focusing on just understanding credit better, and then how we can learn to manage our debts properly, as well as paying debts off. So I'm going to share my screen. Okay. So again, today's presentation is credit and debt management, how managing debt impacts your credit score. So we're going to first start off just going over some credit basics. just so you can have a better understanding how credit works. And then we're going to tie that into learning how to get started with a debt management plan, understanding how to use the debt snowball strategy to become debt free. And then also, we're going to talk about ways you can manage future debts. So, because I will say that having debts are not like always bad. It's just when we have too much debt compared to our income is when we put ourselves in a financial situation or financial crisis situation. So that's where we want to start considering having to repair credit or going through debt payoff solutions in order to get out of debt. So first, I do want to talk about why good credit is important. So again, like I was saying, having debts are not bad. Having a good credit history is important because as we navigate through life, when we're going to apply for future credit, so if you're trying to buy a house, or say one day you get into a car accident, your car is totaled, and now you have to buy a new car, and maybe that car was paid off and now you have to get a new car loan. Having a good credit history and having and managing your debts well means that you're going to have better interest rates. So anytime that you need to utilize credit, you're going to always be offered those lower interest rates. And then it's the same thing with credit cards. Like if you're transitioning to better types of credit cards with benefits, then you're going to get offered those very good intro benefits to where it's like 0% for like 18 months, which can kind of give you an opportunity to pay some high interest credit cards off, or you might get offers of lower interest rates on certain credit cards because you have a good credit history and they trust that you're going to manage and pay on time. And then there's your employment. So for those who are seeking new employment, employers, they can use your credit history as part of their employment screening. It can tell them a little bit of information about you, and how you manage like your responsibilities and obligations. Also, if you're applying for jobs in certain industries that utilize like client or customer sensitive information, or you're handling money, so like you're working in finance or banking. I've also seen insurance, medical insurance companies. I had a client in the past because I do employment coaching as well. So I had an employment coaching client in the past who was applying for an insurance company, and they brought up her collections on her credit report. So for certain types of companies, they might utilize your credit history. So it's good to have a good credit history if you are seeking employment. And then also with your insurance companies that can base your premiums on your credit history. So they're definitely going to be reviewing your credit history to determine what your rates are going to be, as well as to see if you owe other insurance companies. So sometimes that can lead to like a denial of services, or it can mean that you have a higher premium because of your credit history. And then some utility companies, they also might determine eligibility based on your credit history. Again, because this is another company that if you don't pay utilities, it can go on your credit report as collections. So sometimes based on your credit history, it can affect what electricity companies you can get services with, as well as it can affect how much you pay. And then also housing. So your rent Your credit is definitely going to be reviewed when you're applying for rent or if you're applying for mortgages. So your credit your credit history would definitely determine your approval for a rental, as well as it's going to determine how much you have to pay up front. So it'll determine if you have to pay an extra deposit, if you have to pay first and last month rent. Some apartment complexes, they might deny you because of your credit score, because they might have a minimal credit score that they are looking for. Also, if it's an apartment complex that have some type of move-in specials, it can determine if you qualify for those move-in specials. So I do like to say that good credit gonna save you money over time. Bad credit is gonna cost you more money, because you're definitely gonna have to spend more money to prove that you would be a good borrower. So next we're going to talk about just understanding credit and debt. So I want to talk about the credit report versus the credit score. Because a credit report, it basically just a report that includes your previous and current credit history and activity. And lenders, they're going to look at this credit report to get details to understanding the content of your credit history. So your credit score and your credit report are not the same thing. They're two different things. We do have three credit reporting agencies: TransUnion, Equifax, and Experian. And I will say that not all information goes on all three credit reports. When you're thinking of like some of your bigger banks and lenders, and credit card companies, you're probably going to see a lot of those report their information to all three. But not all companies report to all three. So not all collection agencies report to all three. Sometimes if you're using like credit builder options, those credit builders might not report to all three credit reports. And then you have each of the credit reporting agencies, they have their own ways to help you boost your credit score. So that means like that's not gonna, if you're using Experian Credit Booster, it's not gonna boost your credit on TransUnion and Equifax. So that's why it's very important for us to review all three credit reports at all times, because that information can be different. So then there's your credit score. So your credit score, again, is separate from the credit reports and the credit reporting agencies, because the credit score is calculated by two different other companies. So you either got your Vantage credit score or you have a FICO credit score. And so those two companies, they are pulling information from your credit reports to develop a score that represents your credit worthiness. So the higher that score is, lenders see you as credit responsible. So when it comes to our credit scores, all three credit bureaus, they all have their own credit scores. So if you notice, you have three different credit scores, and all three credit scores can be drastically different from each other. And it's like I said before, because not all companies or not all information is reported equally to all three credit reports, would explain why you have three different credit scores. So when you are working on your credit, you want to make sure that you know all three credit scores. And while I'm like on the topic of credit scores, like I mentioned, there's two different credit scoring companies that we're all familiar with. There's the FICO score, which is the Fair Isaac. Hold on, I'm gonna go to another screen so I can tell you the Fair Isaac Corporation. So that score is the widely used credit score. So when you're applying to Capital One or you're applying to Wells Fargo or you're applying to any like big known banking institutions, when you're applying for any type of mortgage companies, or even when you're applying for rent, they are all going to look at the FICO score. So it's important to know and understand your FICO score. Same thing with auto lending too. They're all looking at the FICO score. And there's also multiple FICO scores. So you also need to know what industry, what score those particular industries are looking at. So you have an auto loan FICO score, you have a mortgage FICO score, and then you also have the FICO score that are normally presented to us for free, that we can get for free. And then and it's because the FICO, they update their algorithm on a regular basis. And so the FICO scores based on those particular industry is based on what algorithm that industry is utilizing. So sometimes they're using like an older version of the FICO score versus what the newer version is. Because I get this question all the time. It's like, why is my Experian FICO score on the website is 620, but the mortgage lender told me my FICO score was 605? And again, it's because they're using a different version of the FICO score. Now with Vantage scores, and the reason why I'm talking about the difference between Vantage and FICO is because a lot of platforms that provide free credit scores, for example, Credit Karma or CreditWise, they utilize Vantage, the Vantage score. So it's just another scoring model, just like FICO. But because FICO owns the rights to their to the way they calculate the score, the Vantage, they had to create their own calculations. And even though they utilize the same factors that we're going to go into later, their scores can be drastically different. So again, as a coach, I get the question all the time, well, my Credit Karma score was 680, but the lender pulled my credit report and it says 620. And so there's sometimes a confusion about it, but it's just because it's just two different companies and two different scores. But the idea is if Vantage score is increasing, then that means your FICO score should be increasing. And the thing that we want to make sure our score is going up, because that's the higher our scores are, that means we're going to have better approval odds and better interest rates. As well as it's going to show that we are more reliable when it comes to repaying debts. And it doesn't matter if if you made credit mistakes where your credit score went down. As long as you go through the process of rebuilding your credit score, it's still going to show lenders like, hey, even though this person made a mistake, they still went through the process of rebuilding and now they're trustworthy again. And we're going to trust them now because they rebuild their score back to a higher score. And they're demonstrating that now they are someone who's paying on time and managing their debts wisely. Okay, so when it comes to our credit reports, when it comes to like debt management and then just monitoring our debts on our credit history, we do want to understand how long this affects our credit history. And of course, this is how long these debts are going to be affecting your credit score as well. So the rules for reporting this can be found in the Fair Credit Reporting Act, or FCRA. And the act states that most negative items must be removed from your credit report 7 years from the first date of delinquency. So when we have negative information on our credit report, so for example, you have a late payments, or you have a defaulted account, or maybe you get a collection item from a utility company on your credit report, you do want to understand, like, what is the first date of delinquency? So when did that account go delinquent? Um, and that's going to tell you how long that negative information is going to remain on your credit report. However, just say for instance, you have a Capital One credit card and you stop making a payment for whatever reason, and your first date of delinquency is today. Today is June 3rd. So 7 years from June 3rd, 2026 is when that account will come off of your credit report if you never make a payment ever again on that account. However, if you call Capital One and say, hey, Capital One, I want to make this account current. I'm going to catch up my payments so my account can be current, and I'm going to start making on-time payments. Then that clock starts over. So once you bring that account back to current, and you're making on-time payments, and just say a year from June 3rd, like June 3rd, 2027, you're unable to make payments again, and your account goes delinquent again. So then that 7 years is going to start from June 3rd, 2027, if that makes sense. So when we're looking at accounts, and we're trying to figure out when negative information is going to fall off, we have to make sure that we understand how the first date of delinquency works. The same thing with collections, it's the open date. So the open date that a collection item was placed on your credit report is when that 7 years start. Unless you start making, like, you start a payment agreement with them and you start making payments to them, then the first date of delinquency is going to be based on whenever there's a point in which you stop paying that agreement that you made with that collection agency. Chapter 7 bankruptcy filings are 10 years on your credit report. Judgments, those are 7 years or until the state statute of limitation expires, whichever is longer. So just understanding anytime a judgment is placed on your credit report, just understanding that that's on there for 7 years. Or you need to look at the state statute of limitations to see if it's going to be on there longer than the 7 years. And then money owed to or guaranteed by the government. So this is unpaid taxes or student loans. Those stay on your report indefinitely or until 7 years from the date that it was paid off. And then our inquiries, so anytime we have hard pulls when we apply for credit, those are going to be on your credit report for 2 years. Are there any questions before I move on?
I don't have any in the chat just yet, but just as a reminder to feel free to either unmute yourself or feel free to type questions in the chat, and we can catch them as we go along.
Yes. And then if you need me to stop, if you feel like I'm going too fast, or if you need me to re-explain something, just feel free to unmute or ask in the chat. Okay. So let's talk about correcting errors and fraud on your credit report, because a lot of times when I meet with clients, when it's with about credit, the discussion is around repairing our credit reports because we're wanting to make sure that we're getting certain information off our credit report that should not be on there. Or in some cases, if you're going through the process of cleaning up your credit, you might want to verify information before you start making payments to creditors that's listed on your credit report. So I want to start with verification letters because verification letters is a letter that's going to help you gain additional information about the account that a debt collector or creditor have placed on the credit report. Um, so if you're facing an aggressive debt collector, so if you have a debt collector that's reaching out to you and you're like, I don't know who this collector is, I don't know what this account is about, then the debt verification letter can pause those collection efforts and may deter a debt collector who don't have sufficient information. So basically, you can send a certified verification letter to the debt collector asking them for more information about this debt, and also to ask them to stop with like harassing or aggressive debt collecting practices. Um, Also, if you are intending to pay the debt off, so these are accounts on your credit report, and you know that you had those accounts that you didn't pay, but you're wanting to just make sure that the information is correct before you start making like negotiating with collection agencies. Then you can also send the same letter to resolve an account to get more information about how much you actually owe. And also make sure that because you want to make sure you're paying the right amount and you have the right information before you start negotiating to pay off the account. And then next is disputing information. So this is where a lot of my clients, when they're working on their credit, they're asking about like, how do I dispute information on my credit report? So when it comes to disputing information is simply about correcting errors. So the thing is, Experian, Equifax, and TransUnion, they have to report correct information. They can't just put whatever information on your credit report. Um, so that's why it's important that we review our credit reports on a regular basis, because sometimes mistakes happen. And you want to make sure that you catch those mistakes, because those mistakes can drastically affect whether or not you get approved for something. So those mistakes can cause a drop in your credit score. It can make you look like you owe more than you actually owe. So we want to make sure that we identify an error on our credit report, and then you started to dispute that information with the credit reporting companies. So you're writing the credit reporting companies directly to let them know that you think this information is incorrect, why it's incorrect, and then you should include copies of any type of documentations that's supporting your dispute. Um, so that those copies can be last billing statements. It can also be, maybe it's a receipt showing that you paid an account off, and for some reason that company has not removed the information or updated it as paid. So when it comes to disputing information, the credit bureau, they're gonna want some type of proof that it's an actual error. So And then I do recommend that when it comes to disputing information, it's good to have a paper trail. So sending a certified letter to the credit bureaus. You can also send a dispute letter to the actual creditor as well. It gives you a paper trail. So pretty much when you send any letters to the credit bureaus or to any creditors, you want to make sure it's certified, because then they have to sign for it. And then that lets you know that they actually received that letter, and they should be reviewing that letter so they can respond to you. Because in some cases, if they don't respond to you, then you would have to make note that, hey, it's been 30 to 45 days that I've sent a dispute, or I asked for verification of this debt, and this company still have not proven to me that I owe this debt. So then there's going to be further actions that you need to take. But if you don't have that paper trail, then there's no way to prove that you actually made an attempt to verify or dispute the information. Next is identity theft recovery. So identity theft is anytime there's fraudulent information on our credit report because someone stole our information, such as our social security information, and they opened credit in your name. So when it comes to identity theft, sometimes it's harder to prove, because you have to prove that you did not open those accounts, that you didn't spend the money on the credit cards that were open, or any loans that were open. You have to prove that you did not do that. So it is a bit of a process that you have to go through. Because again, the credit companies, like, if it was easy for us to dispute information, the credit companies, you have to show proof of the identity theft in order for them to remove it. Like, because they have to prove that you didn't actually do it, because otherwise people would be disputing information all the time and saying that someone stole their identity. So there is a process. Identitytheft.gov gives you a detailed strategy and process when it comes to getting fraudulent accounts removed from your credit report. So I do recommend that if you recognize any accounts on your credit report that you did not open, go to identitytheft.gov. You will have to submit a report, as well as follow their recovery plan to get accounts removed from your credit report. So again, it's a lengthy process, because that process does include getting a credit report. Getting a police report. Get a police report, reaching out to all accounts that are fraudulent accounts. So you're going to have to call those companies and speak to someone in their fraud departments. It might be you have to collect some other documentation to prove that that's not your account. And then sending dispute letters to the credit companies with all of your information showing that those accounts weren't opened by you. Is there any questions about verifying and disputing?
There wasn't one about disputing. However, there was one about locking your credit report. Do you recommend, or what's your thought process behind locking your credit?
Um, I would definitely say I would consider, like, if there is a instance that your identity have been stolen, I would immediately go through the process, and that's also part of the process. I would immediately go through the process of, like, locking down or putting alerts or freezing your credit. That's another term. as well as notifying the Social Security office that someone has been using your Social Security number. I would definitely do that if there was any situation where that information was stolen. So just say, for instance, you lost your wallet and your Social Security card was in your wallet, or someone stole your purse or stole your wallet and that information was in your wallet, then I would definitely go through the process of shutting things down um, until things get sorted out, especially with your Social Security number. Um, but I think if you are in the process, like you're going to be opening credit or like applying for things, I think having freezes on your account, it can make the process a little bit longer. Um, but it also is a personal preference if you always want to keep like those alerts on your credit report to where anybody try to apply for credit with your social, it means that there's an added step. So it means like that company have to call you and get some extra verification. So I think this is a personal preference if you want to have those have like the your credit have like the freezes on your credit at all times until you're ready to use credit. But a lot of times I think people do it when there's an incident to where their information was stolen, and there's a likelihood that someone is going to might use that information to open accounts. I hope that answered the question. And I think there's different levels to locking your account too. So I think there's some levels where it's you can kind of turn it on and off. And then there's other options that's that locks it down even more. Um, so I think you just have to look at the different levels of how you put those locks on your credit report. But I do recommend that everybody have some type of account set up to where you're always getting alerts when information has been added or changed on your credit report. So whether you have an Experian account, or if you have like Credit Karma, you can also sign up for an account through like TransUnion and Equifax. Um, that way you're getting real-time alerts. So anytime there's any changes to your credit report, any accounts added to your credit report, you can address it immediately. And then you can also immediately like have to lock down your credit report if you need to. So, just because I know I talked a little bit about credit scores earlier, but I do want to go more into the different factors that make up your credit score, because understanding the factors that make up our credit score is going to help us understand how to build, repair, and manage our credit scores. Um, so there's five factors. So there's payment history, which is 35% of your credit score. So your payment history is going to include on-time payments. It also includes collections and late payments. So those three things affect your payment history. Then there's 30% is the amount owed, or we call it credit utilization or credit usage. This is how much of revolving debt that you're using. So our revolving debts is any type of like credit card accounts or line of credit. So that means like you have a set limit that you can borrow from and then pay it back, and then that limit is replenished. Um, So typically, uh, the credit scoring agencies, they want to see that you're using less than 30% of your total credit limit. And that number, it makes up 30% of your credit score. So when we're thinking about building, rebuilding, and managing our credit scores, the two biggest things we need to really focus on is our payment history and our credit utilization. And when you're thinking about debt management and you're thinking about debt payoffs and you're wanting to pay credit cards off and things like that, you do need to pay attention to those two numbers. Like, are you paying on time, as well as how much of your credit limit that you're using. The other three things, um, length of credit history. So how long have you been using credit, or how long have you had a particular credit account open? That's 15% of your credit score. Then there's a new credit or inquiries, that's 10% of your credit score. And then having a good mix of credit is another 10% of your credit score. So those three things, they kind of have a small effect on your credit score. So sometimes when those things are affected, you might see like small fluctuations with your credit score. And then you work on those things over time. So the length of credit history, that's gonna you're going to be working over that on that over time. So the longer you're using credit, the better your credit history looks, and the better that 15% of your credit score looks. So when it comes to credit cards, and people say never close a credit card, this is why, because when you call and you close a credit card, you lose that length of credit from that credit history, and it affects that 15% of your credit score. Also, when you pay off a loan, and that loan is now closed. If you ever notice, like you paid off a car loan and then you saw like a little drop in your credit score, it's the same thing. Is because once that car loan is paid off, or that installment, any type of installment loan, once you made your last payment and now that loan is closed, then that information is taken out of your length of credit, taken out of the length of credit history. So it does drop your score a little bit, but it doesn't matter, because as long as you have other active credit, it's going to come back up. It's going to go back up.
I wanted to just kind of add to, I know, I'm not sure if everybody knows, there are a lot of people that are doing the, uh, like, Affirm and what are those? What's the other one?
To pay,
Klarna,
Klarna,
yeah, Klarna and all those
PayPal,
kinds of things. They're now reporting to the credit bureaus. So if you
they
haven't checked
do.
your credit, in a while, and you've been using those kinds of services, make sure that you see how it's being reflected and how it's being reported. But also note that your credit score does drop, because every time you pay off one of those small payments, or that you get financed or whatever through them, it will drop your credit score, because now you're no longer having that report that's coming to your credit report over that period of time. So just keep that in mind too, because I know some folks thinking that, oh, well, if it's reporting, then it's kind of helping me with building my credit. Well, it actually doesn't. It's continuing to drop, especially when you do it often. Like you get, a payment for, 3 months, 6 months, a year, or what have you, and then you're done paying it, and then it goes and it's removed from your credit report, and then it drops your score. So just keep that in mind.
And then also, I will note that yes, since it started, they're reporting those on the credit report.
Mm-hmm.
Sometimes I think some people think like, oh, it's just a low monthly payment or something like that. They might not take it as serious, and they're like,
Mm-hmm.
oh, I can skip a payment, or I might get, I can easily get behind and then catch that up. But yeah, now that before when they wasn't reporting to your credit report, they probably wasn't going to report it until it was a collection. But now, so they're reporting it right away. You need to know that it's on there just in case you miss a payment. Then that means your score is going to drop based on the payment
Mm-hmm.
history. Um, but again, like I said, some people might not know that, and then they're thinking like, oh, okay, well, I can't afford to make this $20 payment this month, or I need to wait a few days past my due date or something, or 30, or I'm gonna have to pay it next month, and not knowing that it's on your credit report, and now your score done dropped like 20 points or something like that. So again, like I said, that's why it's very important to be reviewing your credit reports on a regular basis and then set up those alerts because if you open an Affirm account and it's now reporting on your credit report, then you should have gotten a alert in your email from whichever account you're using stating that now you have a new account on your credit report, and then you can go and check and see what that account is. Um,
There's another comment here in the chat or question. You have a credit card that you haven't used in a while, and the company closes it. Does that hurt your credit score?
No. Um, so if you have a credit card account and just say for instance, you have perfect credit payment history on this account, but you no longer want to use it anymore and you're transitioning to another card. Um, when you stop using it after so long, the credit company is going to close it due to non-activity.
Mm-hmm.
Um, but the good thing is you keep all of the credit history from that account. So it does not affect that 15% of your credit score. But if you pay the card off and you call Capital One and be like, hey, Capital One, unfortunately, I prefer Discover and I want to close you guys, then that's going to drop your score. So
Mm-hmm.
say for instance, that was your very first credit card and it had 10 years of credit history on it. You're going to lose that 10 years of credit history because you called them to close the account. But Nia is correct. If they close it, and it'll say on your credit report, closed by the credit company or something like that, something around those that verbiage. Then that means you keep all 10 years of that credit history.
But if they do decrease your credit utilization though, like if you go from a
It
five
does.
thousand dollar credit limit to a $2,500 credit limit, it does drop your score.
Yes. So if you have a usage issue, so meaning that you're using more than 30% of your credit limit, or you're teetering on that line of being over that 30%, once that card is closed, um, then you lose that credit, that amount from your credit limit. So it can change it can affect your credit score at that point too. So
I,
sometimes it can be, hey, just make a couple of purchases and pay it off again to keep it active if you're trying to maintain the credit limit. But some credit card companies, they might decrease your credit limit too if they see that you're not using it, actively using it before they close it.
I did see though, and I'm not sure if it's still being done now, but like during COVID, when creditors were scared of people not paying their debts because they weren't working and things like that, they were decreasing a
They
lot of
reduce
credit
it.
limits.
Mhm.
They were reducing a lot of credit utilization, and it was impacting people's credit scores that way too. So I don't know if they're still doing it, but that did happen as well. It had nothing to do with their,
Mhm.
um, overextending or using more than the 30%. They were just dropping it just because they were scared of people not
Mhm.
paying it back.
I did see that happening because once we was like working virtually from home and I'm still like pulling the people's credit reports, I did have some clients who noticed that, and I was like, well, that's interesting.
Mm-hmm.
Um, so yeah, that is the case. Like, so when we're thinking about like those cards being closed, you also want to you really want to be managing your credit usage and that utilization number, because sometimes you can have perfect payment history, paying on time, but if that credit card usage is over 30%, it's almost like them two things are going to be competing with each other. It's like your score is going to be going up because of the payment history, but at the same time, it's going down because of the credit usage. So later on, when we start getting into like the debt management part and debt payoff, then that will kind of help you start like addressing your credit usage issues, especially if you're paying on time and you're just trying to pay the credit cards off, so your credit usage is not affecting you negatively. And then I also want to point out that our FICO scores, it starts from 300 to 850. It's definitely most people range goal is to get to 850. Usually when you're about like over like 700, you're kind of in that range to where you're going to start seeing favorable rates. And Nowadays, 620 and higher can get you approved for some lending products. Like there are mortgage lenders, they look for 620 and higher. There's some that still look for 640 and higher, as well as there might be an option for 580. So it's kind of important to understand like the range. And then when you don't have credit, when you don't have enough information reporting on your credit history, so just say you just turned 18, and you pull your credit report and it says insufficient credit. So insufficient credit or that just means like that's basically saying that you have a zero credit score. You have no credit score. So of course you should see that when you're just turned 18 and you pull your credit history, unless your parents was helping you build your credit by having you piggyback off of one of their credit accounts. It should say insufficient credit. So then you can start like as a new adult, you can start building your credit score with the credit builder. Um, or sometimes I see seniors, um, they lose their credit score because they're at a age where they have purchased a house, they have a car, everything is paid off. Um, and then of course that generation was a little bit more so used to using cash. So at some point, I've seen like seniors have no credit score because they just stopped using credit. And so there was no information to generate a credit score. So then that's where we have to like start with the rebuilding process again. So I just want to just go back over again, just what affects your credit score. So when it comes to things that increase your credit score, it's going to be any on-time payments on an open account, keeping your credit card balances under 30% of the credit limit, keeping inquiries to a minimum, because we know like the inquiries is that 10% of your credit score. So only apply for credit when you need to. I know sometimes we go shopping I used to work in retail, and back to school and Christmas was our prime time to really try to get people to open store credit cards. So I know like when it comes to like shopping and things like that, we get tempted to open credit cards to save on those purchases. So again, I would just say no to those because when you're applying for a bunch of credit cards, um, then that can cause a drop in your score when you're going over 4 or 5 inquiries. Also, I would talk about going to dealerships. When you go to purchase a vehicle, there's times where the dealership might run your information through a whole bunch of different lenders. Um, Usually, if you purchase a car within 30 days of that happening, those inquiries don't hurt you as much. But just say, for instance, if you don't get the approval that you're looking for, and you end up not buying a car, then all of those hard pulls that they did is going to be on your credit report, and then that's going to drop your score. So a lot of people don't know that when you go to apply for auto loans or you go to a dealership, you can actually tell them what banks you want them to run your credit through. Because I don't know if it's changed again, but I know that some banks they changed their application process to where you have to go through the dealership versus applying at the bank and then going to a dealership. Um, so have a list of the banks that you want them to pull so they're not running your credit through 20 different lenders. And now you have all of these inquiries. Um, Also, we want to make sure that we have a good mix of credit. So have like some type of installment payment as well as a revolving debt, and then have years of positive credit history. So of course, like when we're starting off, I know so we're starting off with new credit, like you're 18 or you're a young adult and you're starting off with new credit. Just learning and understanding credit from the start will help you generate those positive credit years of credit history. But again, sometimes things happen, but you can always restart those years of positive credit history at any time. And then the things that are going to decrease your score is, of course, late and missed payments, high balances on credit cards, high number of inquiries, collection items, and having too short credit history or no credit history. So again, like young adults that are starting off fresh, with their credit history, their score is going to be lower until they generate some years of their credit history. And again, at some point, if you stop using credit altogether and you have no active credit, then your score is going to start to drop down because there's no information to generate your credit score. So that's where you start to lose like your no credit history or no credit activity. Is there any questions before I move forward about the credit score?
I don't see anything else.
Okay. So now we want to move into becoming debt free and how we can create our own personal debt management plans. Um, in some cases, we might need some help, and that's fine. But for the majority of, we can actually create our own debt management plans to get out of debt. And this is whether you feel like you're overwhelmed with the amount of debt you have or you just want to be debt free. Uh, And then also you want to also get to a point to where you're managing your debt very well. So you only have debts that are necessary and you don't have an overwhelming amount of debt that you have a hard time keeping up with month to month. So here are some reasons why it is important to become debt free. So of course, we're going to have an increase in disposable income that can go towards savings and wants. So that's very important because as we do pay off certain debt accounts, then that frees up some income in our budget. So that can allow us to increase our savings and putting that money into savings or some type of saving account, or it could be retirement or investment. That means that money can now work for you and grow versus being a burden. Because as you have like balances sitting on like credit cards and stuff like that, you're building interest that you have to pay back. But when you pay that account off, now that money is building interest that is going to you and not the bank. And then also there might be some wants that you've been like not able to do because of having debt payments. So maybe you want to travel, but you can't because of the debt payments, or maybe there's things that you would like to buy, but you can't because you have to make payments on debts. Then there's an improved credit score and credit history. So when you are paying down credit card debt, then it affects your credit usage. So that means you can have an improved credit score, especially if you're utilizing more than 30% of your credit score, as well as making those on-time payments to pay. To get closer to paying debts off is going to improve your payment history. And lenders, they do, even though like we said, those installment loans, it's going to drop your score a little bit because they're closing, but it's also showing other lenders that you can borrow and pay people back as well. So that's going to improve your credit history and approve your eligibility to get approved for further credit in the future. It's going to lower your debt to income ratio. So when you're going through the process of purchasing a home, the debt to income ratio do matter. So it is going to lower that ratio because you're going to have lower minimal debt payments that you are obligated to pay each month. And then also it's going to lead to less stress and less financial burden. So a lot of times when it comes to stress around money, debt can be one of the main culprits. Sometimes people can feel weighed down with the obligation of having all of these debt payments that they have to make. So as you pay these debts off, that means there's less things that you have to worry about, less financial burdens that you have to worry about. So how do we get started? So to get started, first we want to look at our credit reports and make a list of everything that we owe. And then also we want to add debts that are not on our credit reports. So maybe it could be a utility account that you owe that haven't hit your credit report yet. Some people might want to include paying back family and friends. So definitely you want to make sure you have a clear list of everything that you owe. And then next we're going to take a deep breath because we can get out of this. We just going to have to make a plan. So when it comes to getting started with the plan, we want to get organized. So with our list of what we owe, we want to make a separate list of what's current and what is considered a delinquent bill. We want to make sure amounts due and balances are up to date. So current accounts that are open, you definitely want to make sure you have the current amount that's due. And so that can be through your bill statement. That can be through looking at that account online. It can also be sending in verification letters. But you want to make sure that everything you owe is up to date. For accounts that have been closed or collection accounts, then utilizing the verification letter can allow you to get the information and make sure that those amounts are correct and up to date. Also, we want to look at our budget. So we want to know our budget and we want to know how much money do we have available to manage and eliminate debt. I know we talked about budgeting a few months ago. But if you do remember, a budget is the foundation to any financial goal, and that budget should be created based on your accurate spending, because that's how you can determine how much income or how much extra income you might have to put towards paying debts off. And that might mean that you might have to reduce spending in other areas to put towards your debt management plan. So once we have an understanding of how much we have to eliminate debt, then we want to determine what we want to pay off, negotiate a settlement, or do we want to walk away? So some accounts that have been like defaulted accounts or collection accounts, you might want to decide like, hey, you know what, I just want to pay it off in full. So then you just reach out to those companies and pay them off in full. Or you can negotiate with them a settlement of paying less than what the balance is. For collection items, that negotiation might include both the payoff and the settlement negotiations for collections can include asking for deletions. So just negotiating that, hey, if I pay this off in full, or if I pay this agreed settlement amount, will y'all agree to remove this account from my credit report? Now, for trade lines, that might be a little bit more difficult, because the trade lines, they're just gonna update your information to show that the account was paid or settled. But collection agencies, you can ask for a deletion. And then walking away, just meaning that you are going to wait for the 7 years for that information to not report anymore. But keep in mind, you still owe it. It's just not reporting on your credit report. Then next we want to consider debt consolidation options. So debt consolidation is going to fall into like if you have like installments and credit card accounts that you're wanting to pay off and you want to consolidate them into one payment. There's different types of debt consolidation, so it's important to understand the different types of debt consolidation. So there are debt consolidation to where basically you're applying for a personal loan that's large enough to pay off multiple debts and put them under one payment. So that's where you have to have a good credit history to qualify for a debt consolidation loan. And usually the goal with the debt consolidation loan is, again, you're going to pay off multiple debts with that one loan. So you can have one monthly payment and possibly a lower interest rate compared to the debts that you paid off. So a lot of people, they use this strategy when they have multiple credit cards. And if you think about a credit card interest rate being 20+%, and then you have a good enough credit history, so you get approved for a debt consolidation loan that have maybe a 12% interest. So in that case, you done cut the interest that's owed on those principal balances from those credit cards. You're going to cut that interest down when you pay it off with the loan. But we must be careful when we do this strategy because we want to make sure that if we pay off credit cards with a debt consolidation loan, that we don't start using those credit cards again. And we want to make sure that we take the time to pay off that consolidation loan before utilizing those credit cards again. And because what can happen is, of course, like we said earlier, it's advised not to close a credit card because you lose that credit history. Um, so we do want to make sure that we leave the cards open, but we want to take away access to using them because we don't want to rack up the debt again on the credit cards. And now we're paying the loan, plus we're paying minimum payments on the credit cards again. So this process does require some discipline, I would say, but it is a good option if you do have a good credit history and you can transfer the credit card debt to a lower interest loan. Um, Another debt consolidation option I wanted to talk about because again there are different types of debt consolidation because there are like debt consolidation companies, and I want you to be aware that debt consolidation companies, there are two different types of ones. Because there are some that they mostly deal with debts that are already defaulted on, and you're basically paying them to contact those companies and negotiate settlements. And then you're paying interest and admin fees to them. And so that one monthly payment that you're making to the debt consolidation company, it's gonna include whatever settlements they made for those debts plus interest and fees to that debt consolidation company. So that's why I said it's very important to understand like the different types of debt consolidation to make sure you're choosing the best option because some of the for-profit debt consolidation companies, they charge very high admin fees and interest. And although they promise you that they're cutting your debt balances in half, the amount of interest and fees that they charge is you're almost paying the same amount that you would have been paying if you had did your own negotiations. The next option is contacting credit card companies to negotiate lower interest rates or a debt payoff plan. So if you don't know, just like I said, the for-profit debt consolidation companies, basically you're paying them to reach out to credit card companies to negotiate settlements or to negotiate payoff plan, like a payoff plan for you. You can do that yourself. So, and it doesn't matter if the card is defaulted and closed, or if you've been paying on time, but now the balance is too high and the minimum payment and interest is too high, and all you want to do is pay this card off. You can contact the credit card company and negotiate a payoff plan. And with this payoff plan, it does mean that the card is going to be closed. So you do lose that credit history from that card as well as the limit from that card. But in some cases, that small drop in your credit, um, over time can benefit you because now you can get this card paid off. Because sometimes they will offer you a lower interest rate and a lower minimum payment or monthly payment, and then they'll give you a term. So they'll say, okay, well, we'll lower your interest to, let's say, 11%, and you, instead of paying 250 minimum payment, maybe you're paying like 100 or 150. And then they'll set that term to like 3 or 4 years based on your balance. So that means you can get the card paid off faster and pay less interest. And so the only downfall is you lose the credit history from that card. And then that limit is not included in your total credit limit when it comes to your credit usage. Um, Next is getting debt counseling through a credit counseling agency. Um, so if you feel like you don't want to go through the process of contacting credit cards one by one to negotiate payoff plans or lower interest rates, you can utilize a debt counseling agency to do the negotiating for you. And then they also do debt consolidation as well. I do recommend looking for a nonprofit debt counseling agency because that means that there's going to be lower fees that you might have to pay. So I do, although we're not sponsored or anything by Money Management International, but the reason why I recommend them is because I've had clients who used them before. Um, and they are a nonprofit organization. So you're not gonna run in a situation where they're gonna be charging you high interest and fees to help you create a debt consolidation plan. Miss Smith, did you have a question? I saw you was off mute.
I think she may have lost her mic because I don't see it there.
Okay, okay.
Go
And then
ahead. We'll let her
okay,
catch
yeah,
up
she
in case
chimed
she
in.
does.
Yeah. Um, So Money Management International is the one I know, but there could be other options available. But I would just say when you're looking for the debt counseling agencies, I would definitely look for nonprofits so you can save on fees. Um, and then money management, they also help you. So just say if you have on-time payment history, and again, the only issue is your credit card balance. And so now you're trying to get out of credit card debt, even though you're paying on time. Money management is not going to ask you to go into default before they can help you with the credit counseling and debt consolidation plan. They can work with you even if you have on-time payment history with those credit cards. And this is important because there are a lot of people who, again, they have perfect payment history, but the only issue is they have high credit card balances. um, and so they only want to work on those credit card balances. But when a company is asking you to go into default, then that means you have to make late payments. So you have to stop paying. So you might have a really good credit score because of you're paying on time. But your credit score is just not um, increasing more because of the balances of your credit cards. So when a company asks you to stop paying so they can help you, then that's going to drastically drop your credit score. So you definitely want to look for debt consolidation companies that's not going to ask you to jeopardize your payment history in order to help you negotiate with credit card companies and create a consolidation plan. So definitely look out for that. Because that does matter if you already have a good payment history. You never want to jeopardize your payment history to do that consolidation plan. And then lastly is determine if you need to declare bankruptcy. So if you feel that you might qualify for bankruptcy, you definitely want to speak to a lawyer and get legal advice. Because bankruptcy is a legal matter. This is not something you want to kind of go and just manage on your own. You want to make sure that you're speaking to going through bankruptcy counseling, as well as speaking to a lawyer. There are legal services for individuals with low income that might be able to help with bankruptcy. So definitely seeking out those resources. As well as I think Money Management International, they might do bankruptcy counseling there to like kind of help you decide if it's the best option for you. But I would say always seek legal advice before you start going through the bankruptcy process. Was there a question? Did anyone have any questions um, about this part?
I don't see anything in the chat.
Okay. I think I had saw a mic turn on and also I was asking. And then also just keep in mind, bankruptcy should be a last resort. Like you should have exhausted all other options, all of these other options before you get to the bankruptcy point. Because when you file bankruptcy and you complete the process, again, like before we saw that it's on your credit report for 10 years. Um, so although you can go and start rebuilding your credit history, but it's just going to be a little bit difficult rebuilding your credit history. So just say for instance, if you wanted to buy a house, you're gonna have to wait a certain number of years before you qualify. So that can delay your options to buy a house. Um, of course, like any lenders, like for instance, if you have to get a new car, then that means that you're gonna have to have higher interest rates on an auto loan. So just make sure that whenever you're considering it, that it's a last resort. Like there's no other options that you can utilize, and then seek the legal advice. Um, the creditor arrangement sheet, because like I talked about earlier, just having a list of everybody you owe. Um, you can create this document how it fits for you or work best for you. This is just an example of one that we used to utilize here at Family Houston when we're talking to our clients about their credit reports. And then we'll send it to them so they can use it as a way to organize their information. Um, so when you have it kind of like written out like this, whether it's in a notebook, it's on a spreadsheet, um, it just makes things a lot more tangible to see what you're working on. Having contact information, if you're calling companies to make agreements and things like that, you want a place where you can put notations of who you talked to, what agreements were made, um, and so forth, just so you can be aware of what's going on with your debt management and debt payoff plan and process. Um, One thing I like to do for myself and for some of my clients, I like to include a little table on my budget, my monthly budget sheet, and it has all my debts I owe, how much I paid that month, and my remaining balance. Um, and that helps me keep up with how much I owe, and that I made a payment. And then it motivates you to kind of keep moving forward when you can see what you're working on and you're checking things off. So as you pay things off, you can literally see those debts disappearing, and it just keeps you motivated. Did we have did we have a question? Okay.
You wanted
Someone
me to
said that
I
too.
do that too. Yeah.
Okay. So I'm thinking you're referring to like tracking your debt payments and balances on your budget sheet. But again, like I said, it's just a great way to see if there's things that just to see how much you owe, like your total debt amount that you owe, to be paying attention. Like if you have a car note, it's exciting to see. It's always exciting to me to see my car note getting smaller and smaller, my car loan getting smaller and smaller. So it's just a great way to kind of stay motivated, and also just being in the know of everything that you owe. And then also accounts like we talked about, um Afterpay, Affirm, Klarna, PayPal, those like quad pays. Um, those are also important to include on that list. Um, because you also want to just keep in mind how much of those you're utilizing, because usually what happened with like Afterpay, and those like they're paying for it, sometimes people are not tracking how much they owe, and then now they're unable to pay them because they taken out too many of them. And so even though they're like these little small payments, if you're taking out too many of them, then they're going to get harder for you to pay that month. So it also allows you to track debts like that, so you can make sure that you're not using too many of them to where it might become a credit issue. Okay, so we have our list of our debts. We have the things that we want to work on, that we want to pay off. So now we want to create a debt snowball plan. And then you can put like a thumbs up or anything if you've heard of the snowball plan. It is a popular plan within like the debt payoff community. I know, I think Dave Ramsey is a financial expert that made the debt snowball plan popular at some point. But it's a perfect strategy to try to pay off debts um, as fast as possible. So the snowball is pretty much starting with the smallest balance and working your way up to the largest. You're going to determine the amount that you're going to add to your minimum payment. So the snowball is the extra payment that you add to your minimum payment. Once the debt is paid off, then you're going to transfer the snowball amount plus the minimum payment of the debt that you just paid off to the next debt that you're working on the list. So, for example, if you have three credit cards that you're paying, and just for easy math purposes, let's say each credit card had a minimum payment of $100. So your total minimum payment for the month on three credit cards is $300. Well, you decide, hey, I want to pay all three cards off. I'm going to do a snowball plan. And you decide that I'm going to pay an extra $100 per month uh, to pay these cards off faster. So that $100 is going to apply to card number one. So card number one, you're going to pay $200. Card number two and three, you're going to continue to pay $100 minimum per month. So now your total payment that you're making per month is $400. Once card number one is paid off, you're going to take that $100 snowball plus that $100 minimum payment for card one, and you're going to apply that $200 to card number two. So now you're paying $300 on card number two and $100 on card number three. Once card number two is paid off, you're going to take the $300 and you're going to apply that to card number four. I'm sorry, card number three. So now you're paying $400 to card number three until that card is paid off. And so if you notice, because, and if you want to understand why it's called snowball plan, as you see that with each credit card, the amount that you're paying towards that credit card is increasing. So that means like that snowball amount is getting bigger with the individual card. And then because you're paying so much more, then that debt is going to be paid off quicker. So when we're going to create the debt snowball plan, we want to determine again what our snowball amount is going to be. And that's where your budget comes in. Your budget, you already have your minimum payments on your budget that you're making on-time payments to, but now you need to figure out how much extra can I pay towards the minimum payments on the credit cards that I'm already paying. So that could mean it could be cutting back on some things, so you have that extra money. Then you want to list your debts, so the names, balances, interest rates, and minimal payments. And then you want to decide the order in which you want to pay. Do you want to pay by balance? So usually by balance means smallest to highest, or by interest rates. Some people do high interest to low interest, or it might be a custom order that you decide that you want to pay. Um, then there's now if you're somebody like me, if you've been to any of our previous presentations, you will understand that I love a good spreadsheet, and I love a good spreadsheet that I did not create that calculates everything for me. Because I'm a person, I like efficiency. And so there is a debt reduction calculator. It's a spreadsheet. There's also websites you can use as well that has the debt reduction calculator, because this debt reduction calculator is going to tell you all of the information you need to know on when you will be debt free. But you do have to have all of this information. So you need to know your current balance, your current interest rates, and your current minimum payments. So you can get all that information from your lender or credit card website. You can also get that information from your statement balances or your statements that you get, whether it's in the mail or you download them online. When you use a debt calculator, it would also help you determine like how much you want to put towards as your snowball amount. Because if the sooner you want to pay off those debts, the higher your snowball is going to need to be. So the debt calculator would tell you like how much your snowball needs to be if you're trying to pay a debt off by a certain date. For instance, I've had clients, like we've used this for a client who got a 0% interest credit card, and they wanted to know, can I pay this balance off in this 18 months, and how much do I need to pay? So the calculator kind of helps us figure out that information. And then also, in some cases, individuals might want to do some extra payments outside the snowball plan, and those are called snowflakes. So just say, for instance, you get a bonus or you get your tax return, and you decide that I'm going to pay a big chunk towards the balance, then that's considered a snowflake. So this is the spreadsheet the debt reduction calculator spreadsheet. Again, Vertex 42, this is a website that we've spoken about in previous presentations. Vertex 42, they have different financial spreadsheets that you can utilize for different types of personal financial goals. And this is one of them. If you see, it has the balance, the balance date. So this is the date that you're going to start your snowball plan. So you want to make sure that the balances, interest rate, and minimum payment is current to the start date. And then down here where it said monthly payment, the monthly payment is going to be the amount that you plan to pay. So earlier when I gave the example where the total monthly payment was $400 and the snowball was 100. So if you know that you want to pay $400 a month towards all of your debts, then you're going to put that amount in, and it's going to let you know what your snowball is. But right here where you said 219, that's a total amount of just your minimum payments. So you definitely want to make sure that your snowball, that the monthly payment you put in is more than what the total amount of minimum payments is. Then it has the strategy options that you can choose. Also, this calculator, it gives you instructions and all the information you need to know and understand what to put where. So it's very self-explanatory. And then here at the bottom is where you can see when these debts are going to be paid off based on the interest rates and the amounts that you're paying. So this is the part I like, because this is where you can create a SMART goal, and you can say, I want to be debt free March 2022. This has an old date on it, so this person could have said, I want to be officially debt free, everything, all of these accounts paid off by March 2022. And then they can set that SMART goal, because now they have a due date as to when they're going to pay these debts off. They have a way to track their progress, as well as they have a clear and well-defined goal and strategy to accomplish the goal. And then the next tab is going to show you your payment schedule. So I like this tab because you can see how everything is going to is decreasing. So this can help keep you motivated, because as you're paying these debts off, these amounts are getting smaller and smaller. And then it also is letting you know what you need to pay on each card per month. And then as you're paying things off, it's telling you, okay, well, this Capital One is paid off. So now instead of paying 36 on First Premier, you're going to increase that to 93 and then to 111. So you know exactly what you need to pay each month until all the cards are paid off. Now there might be times where you might have to redo this spreadsheet, especially if you make an extra payment, just so you can redo your payment schedule. But it shouldn't be much effort to recreate the payment schedule. Is there any questions about the snowball plan? Has anyone attempted to do a snowball before? Or heard of a snowball plan?
Everybody's so quiet.
I know.
Go ahead.
Yeah, keep going. So I do want to talk about just building good credit history. Um, so when it comes to building good credit history, so this is whether you're starting off from scratch or you're repairing credit history and you're starting over. We want to start as soon as possible. Because again, the length of credit history matter when it comes to building your score. Uh, so if you don't have any active credit history, we want to start as soon as possible. Um, and there's and again, everybody has an opportunity to not have active credit history. So it can be you are now you're a new adult and you never used credit before in your life. You have credit history, you have accounts that you use, but maybe not all those accounts are closed. So that means there's no activity that's helping generate your credit score. Um, or again, you haven't used credit in a long enough time to where all of the information on your credit history has now expired and is no longer on your credit report. So when we are aware of this, we want to make sure that we're starting as soon as possible. Or, I mean, you just starting over. You want to start, you have accounts that maybe um, you went delinquent on those accounts and you have the ability to get them current, and now you can start paying on time and things like that. So we want to make sure that we're doing that as soon as possible. Um, when we're rebuilding or building or establishing credit, we want to start small. So start building your credit history with affordable credit builder options, such as a credit builder loan and I would say and a secure credit card if you don't have a revolving debt already, because you still need that credit mix. Just make sure that when you're utilizing the secure credit card, that you're not going over 30% of the limit. Aim to pay off each month and then keep monthly payments budget friendly. So any type of builder loans and secure credit cards, just making sure that those monthly payments are budget friendly. So we want to make sure that when we're building good credit history, that we're paying on time moving forward. Um, and then paying bills on time. So payment history, since it is such a big factor that affect your credit score and history, we want to make sure that any obligations that we have, that we're paying on time. And this goes for things that are not even being reported to the credit report. So your rent, your utilities, cell phones, um, what else? Even the paying fors, Affirm, Klarna, Afterpays, even those two, we want to make sure that we're paying any obligations. We want to make sure we're paying on time, because we don't ever want to get surprised by a collection, um, and have that drop our score. And then just some other tips to help you maintain good credit. Utilize the monthly budget. Have a month is once you get started, like once you get started with a monthly budget plan, it gets easier and easier each month. Uh, uh, Having it digital, like a spreadsheet, It's going to save you the most time because all you have to do is duplicate that spreadsheet every month. All of your information is there. You just have to like make changes to certain numbers based on those changes for that particular month. But having a budget plan based on your accurate income and spending is going to be very, very essential and important to you managing your debts, as well as managing a debt payoff plan. And also understand that credit card does not mean you have more income, because a credit card is always going to be an expense on your budget. So just making sure that when you get when you do open credit cards, um, that whatever you spend, that is going to be an expense on your credit on your budget. I'm sorry, on your budget. Um, as we are paying debts off, we do want to like transfer that money, the extra income, and create an emergency fund, or if possible, save up for big purchases. So saving up for big purchases can reduce the amount of debt that you have, because again, we don't want to overwhelm ourselves with our debt balances and how much monthly payments that we have towards debts. So having an emergency fund and saving up money to cover to reduce the amount that we're borrowing for big purchases would reduce your debt balances a lot. I mean, I've talked about paying bills sometimes, maybe multiple times. But again, this is very important because it is 35% of your credit score. Um, as well as lenders, they can use your payment history against you when it comes to them making decisions on whether or not they of what your interest rates are going to be, or if they're going to approve the loan that you're applying to. Um, Paying credit card bills off, like paying your statement balance off in full each month, or just making sure that you keep the balances under 30%. I have annually, but we want to check our credit report on a regular basis because we want to make sure that there's no errors or identity theft on our credit report, because we want to dispute that information as soon as possible. Only borrow what you can afford to pay back within 30 days. Because after 30 days, that's when late payments are reported to the credit bureau, and that's when you can see a drop in your credit score. So only borrow what you can afford to pay back. So that's with credit cards, that's with any type of new installment loans that you're getting, um, making sure that that monthly payment is what you can afford to pay. And then we want to make sure that we are protecting our identity. So just being mindful of who we are sharing our personal information with. Um, so we can avoid any type of identity theft situation. And then lastly, here are some debt management resources that you can utilize as you work towards debt payoffs, as well as managing your debts on a regular basis. So we have our free credit reports and where we can get our credit scores. Um, Annual credit report is a good and safe website to pull all three credit reports. Experian have a free account, and they provide a free FICO score for their report. MyFICO.com, they provide a free Equifax FICO score. But they do have memberships where you do have to pay for all your other FICO scores. But I will say excuse me, I will say that my FICO is a good it's a good account to have if you are working towards buying a house, because it's very important to understand what your mortgage scores are so you don't have the lenders repeatedly running your credit. So I do recommend just investing in my FICO to pay for so you can have your accurate credit scores when you're in the process of purchasing a home. But if you're just monitoring your credit scores to see if they're increasing, then the free options are good. Credit Karma is free credit history and monitoring. They do provide a free credit score, but it is a Vantage score. So again, if you're just monitoring your credit score and you just want to know whether or not your score is increasing, um, then the Vantage score is okay for educational purposes, but I definitely would not rely on it as knowing whether or not, like, if you wanted to compare it to your mortgage score or any accounts that you're applying to that utilize the FICO score. That's when you're gonna want to just go directly to FICO. And then your online banking and credit card companies, they do provide free credit scores as well. So you do want to be aware of which credit score that they're providing. So some they might require, I mean, they might provide the FICO score, or they might provide credit-wise or Vantage. So credit-wise and Vantage is the same thing. Um, so just be aware of which one they provide. And then they don't provide your score from all three credit bureaus. They usually have one of them that they use. So you'll definitely have to check and see like which score, which report they are using. Um, so if you need to know like your other credit scores, then you'll have to seek out that information. And then again, Money Management is a nonprofit credit counseling organization that I recommend because I just heard good things about them. And then Family Houston, we are available for free financial coaching. So with the financial coaching, we can help you understand your personal credit history better. We can talk through any type of credit repair or credit building strategies you're wanting or needing to do to increase your credit score. We can also work with you on any type of plans on like verifying and correcting errors on your credit report, as well as helping you through like the identity theft process. Um, we can also help you create a debt payoff plan. I use that calculator all the time to help my clients with snowball plans. And then the best part about having a financial coach is not only are we there to kind of help you with creating the strategies around accomplishing your financial goals, we are there as for accountability and support. So you have someone that's going to check in with you monthly to see where you're at on your with your credit. Also, we do pull the TransUnion credit report for free. And we can provide the FICO 4. So I believe FICO 4 is kind of close to what a mortgage score is. So if you're working towards bettering your credit and preparing to buy a house, then we can definitely let you know, give you a free TransUnion FICO score through our program. And then we can meet with you virtually or in person. So we try to make it as convenient as possible. And we have coaches in multiple areas of Houston. So I'm the coach for Bay Area. I go to Bay Area, Clear Lake area once a week. And then I'm in our central office. And then we have two other coaches in the central office. We have one coach that meet with adults, and then we have a second coach that he works with our youth program. So if you have young adults who are wanting to establish their credit, then through our Youth on the Move program, they can work with myself or the other financial stability coach to help them learn about credit and how to establish their own credit history. Um, and then also we have a coach in Fort Bend, and we have a coach in Waller County that serves like the Katy and Waller area. And this is just in case you want to meet with someone in person. Otherwise, we're all available to meet virtually. Is there any like final questions or comments before we end today?
I don't see any.
Okay.
I don't
So
see
this
any questions here.
So this is my contact information. If you want to reach out to schedule for financial coaching, or if you simply have a question or you're looking for resources, I am not a gatekeeper. Uh, you don't have to be a client to get information from me because I feel like important information should be shared. So just feel free to reach out to me. My You can contact me via my cell at 832-987-2023. My office number is 713-861-4849, extension 7739. And then my email is mchaney@familyhouston.org. Um, and then you also can visit familyhouston.org to schedule with a financial coach as well. And then for our youth program, if you have any youth or young adults 14 to 24 and you want them to learn about financial literacy, career development, entrepreneurship. You can scan the QR code to sign them up. They do get to meet with, again, a one-on-one with a financial stability coach. We provide monthly workshops that they can log into. As well as we provide employment resources, and then a micro grant if they have a business that they are operating or wanting to start. And then Family Houston, I don't have a slide for it, but we started our Credit Now series. So it's every third Saturday of the month at 10 a.m. And you can check familyhouston.org to register for those events. So basically, we're diving deeper into different credit topics. So this month is going to be about home buying because it's Home Buyer Awareness Month. That's June 20th at 10 a.m. We're going to skip July. And then starting in August, we'll have a new credit topic that we'll be covering in August. And that's all I have.
All right. Well, thank you very much, Monet. If you want to go back to the screen, it's got your contact information on there just to Yep, there it goes. We want to thank you all for joining us this evening. You will receive a copy of the Money, Health, and Wealth Financial Capability Flyer that has the complete list of all the series. This particular series, we host the first Wednesday of each month from 4 to 6 p.m. Again, all of our sessions are recorded. We do send out the link for all of our recordings as well as post the videos onto our YouTube channels. And then we also broadcast live on social media on YouTube as well, and broadcast on our other social media platforms. So you can find a way to get to us on some level or another. So if there are some series or some information, some topic that you all need more information about, then please make sure that you complete the survey at the end, or shoot me an email or something to let us know, hey, like, hey, we need more information about this, or I know a group of folks that are interested in coming out and learning more information about this. So there you will receive our calendar as well, that's got our list or our series of all of our other workshops that we offer, because again, in collaboration with all of those other organizations, we do offer other asset building and asset protection workshops related to whether it's reverse mortgage, Medicare, title fraud, deed scams, wills, estate planning, clearing title, property taxes, and a variety of other classes, in addition to first-time homebuyer education. If you guys know of anyone that is interested in homebuyer education, in addition to the information that Monet goes over, our particular class that we do once a month on a Saturday is one of the HUD certified classes that will allow someone the opportunity to apply for the various down payment assistance programs. It helps with, it is the class that fulfills the educational requirement that allows you to apply for the down payment assistance. So we do host that class once a month. And again, there's a variety of different workshops and things that we do offer, and we'd love to hear from you guys if there's more information that you'd like to receive or need more information about. Tomorrow, we are hosting our wills and estate planning Part 1, wills and advanced legal planning, and why do you need it? Dispelling all of those myths about what people think about why is it that they don't need a will. Oh, I'm married, I'm automatically going to get my share, my husband's property or spouse's property, or oh, all of our family gets along already. We don't have a problem with dividing up anything, or things like that, or I don't have anything, or I don't necessarily need a will. But there, you'd be surprised as to what why it is that you actually need to protect all the assets that you actually do have. So we will be broadcasting that one at the Cashmere Garden Library that's over off of Lockwood, 610 in Lockwood area. I haven't. 610 in Lockwood. And we will be doing that one virtually as well, virtually and in person. So we're trying to slowly get back out there and do our in-person sessions and offer them still on a hybrid platform for folks like you that need to attend virtually and can't attend in person. So we're trying to do both here still. So, but give us a little bit of time for us to be back out there and get all those kind of scheduled in together. But again, we want to thank you all for joining us this evening. Hope you all received the information that you intended to receive. Please take a quick moment to complete our post-event survey that pops up on the screen following this presentation. We really appreciate your feedback. So without further ado, we're going to go ahead and let you have the remainder of your evening back. Thank you guys again for your continued support of Neighborhood Recovery and Family Houston and the month of service partners, because we do put forth a lot of effort to make sure that we get as much of accurate information as we can. We know that a lot of folks rely on social media and all these different platforms that that may not necessarily be giving you the most accurate information. So we don't want you guys out there listening to the street committee or somebody trying to tell you, oh, when I did it like this, or what happened to me. Everybody's situation is completely separate. Laws don't apply to, the state of Texas. People kind of make blanket statements, and you have to kind of know or be sure and be conscious of where you're getting all your information from and making sure that you have a trusted, reliable, local source that you can go to and reach out to get, again, the most accurate and up-to-date information that relates and is relative to you all in your communities. So with that being said, thank y'all again. You all have a wonderful remainder of your evening. You all take care of yourselves, stay safe, stay dry. If you're driving or have to get out there in this rain, take care of yourselves, and we will see y'all next time. Thank you again, Monet.
You're welcome. Thank you guys for attending. Good night.